Have you ever dreamed of earning income without actively working for it? Imagine money flowing into your account just because you own a piece of a successful company. This isn't a fantasy, it's the reality of dividend investing. Dividend stocks offer a compelling avenue for passive income. They represent shares in companies that choose to distribute a portion of their profits directly to their shareholders. These payments typically occur on a regular basis, most commonly every quarter. Unlike growth stocks, which primarily rely on their stock price appreciating over time, dividend stocks provide a tangible return in the form of cash payments. This makes them a unique and attractive option for many investors. The benefits of dividend investing are significant. It provides a regular income stream, which can be incredibly valuable whether you're saving for retirement or simply looking to supplement your current earnings. This consistent cash flow is a powerful tool for building wealth and helps in achieving a wide range of financial goals. So, how exactly do dividends work? It's quite straightforward. When you invest in a dividend-paying company, you purchase shares, becoming a part owner. As the company generates profits, its board of directors may decide to share a portion of those earnings with shareholders. These distributions are known as dividends. They can be expressed as a dollar amount per share, for example, 50 cents per share. More commonly, you'll hear about dividend yield, which is the annual dividend per share divided by the stock's current price, expressed as a percentage. A higher yield might seem incredibly attractive at first glance. However, it's crucial to approach high yields with caution. A very high dividend yield could indicate that the company's stock price has fallen significantly, potentially signaling underlying financial struggles. This situation carries a risk of dividend cuts or even a complete suspension of payments. Always remember that a sustainable dividend is far more valuable than a temporarily high one. Before you invest a single dollar, thorough research is paramount. Diving into dividend stocks without understanding the underlying company is like navigating a ship without a compass. Your investment journey needs a clear direction. Start by analyzing the company's financial health. This means looking at their financial statements, including revenue, earnings, and debt levels. A strong balance sheet and consistent profitability are key indicators of a company's ability to sustain dividend payments. Next, delve into the company's dividend history. Look for a consistent track record of dividend payments, ideally one that shows a pattern of increasing dividends over time. Companies that consistently raise their dividends demonstrate a commitment to rewarding shareholders. These companies, often called dividend aristocrats or dividend kings, if they have decades of increases, prove their ability to generate sustainable profits through various economic cycles. A long history of dividend growth is a powerful sign of financial stability and shareholder focus. A fundamental principle in investing, especially with dividends, is diversification. The old adage, "Don't put all your eggs in one basket," holds immense truth here. Relying on just one or two companies, no matter how strong, exposes you to unnecessary risk. Diversification strategies involve spreading your investments across different sectors of the economy. This means not just tech stocks, but also healthcare, consumer staples, or utilities. You should also diversify across various companies within those sectors. This approach helps mitigate overall risk. If one company or sector faces a downturn, your entire portfolio isn't devastated. It creates a more resilient and stable income stream. For new investors, or those looking for instant diversification, consider investing in dividend-focused exchange-traded funds, or ETFs. These funds hold a basket of dividend-paying stocks, providing broad exposure with a single investment. ETFs offer instant diversification and often benefit from professional management, making them an excellent starting point for building a dividend portfolio. Understanding the tax implications of your investments is essential for effective financial planning. Dividends, like other forms of income, are subject to taxation, and how they are taxed can vary. Generally, dividends are taxed as ordinary income, similar to your wages. However, some dividends may qualify as qualified dividends, which are often taxed at lower capital gains rates. This classification depends on factors like how long you've held the stock and the type of dividend. The rules around dividend taxation can be complex and vary based on your individual circumstances and jurisdiction. It's always wise to consult with a financial advisor or a tax professional. They can help you understand the specific tax implications for your situation and ensure you're making informed decisions. Proper tax planning can significantly impact your net returns from dividend investing. Building a successful dividend portfolio requires both patience and a long-term perspective. This isn't a get-rich-quick scheme. It's a strategy for steady, compounding wealth accumulation. The real magic happens over years, not weeks or months. One of the most powerful strategies for accelerating wealth accumulation is dividend reinvestment, often referred to as DRIPs. Instead of taking your dividend payments as cash, you use them to purchase more shares of the same stock. This simple act significantly boosts your investment. This leads us to the incredible power of compounding. When you reinvest your dividends, those new shares then earn their own dividends, which in turn buy even more shares. This generates a snowball effect. More shares lead to more dividends, which then buy even more shares, creating a virtuous cycle of growth. Over time, this compounding can dramatically increase your portfolio's value and your passive income stream. Dividend investing offers a viable and powerful path to earning passive income from the stock market. It's a strategy that rewards patience, diligence, and a long-term outlook. By understanding the fundamentals, you can build a robust income-generating portfolio. Key success factors include conducting thorough research into the companies you consider. Always analyze their financial health and their history of dividend payments. Diversifying your portfolio across different companies and sectors is also crucial for managing risk. Finally, always consider the tax implications of your dividend income. This ensures you maximize your net returns. Approach dividend investing with a long-term mindset and a commitment to ongoing learning and adaptation. The world of finance is always evolving, and staying informed will help you navigate it successfully. Embrace the journey and unlock the potential of passive income through dividend stocks.